Company that takes that kind of risk and makes those kind of mistakes, I'm never going to trust them again. And that's kind of how I am as an investor. If a company makes a major mistake once, I'm out. Hey everyone, it's Ian. I'm back with another video about dividend growth investing. Today I want to discuss the topic of dividend cuts. I have been hearing a lot of questions on my channel. I appreciate them. Thank you. Please keep the questions coming about, oh my goodness, Ian, GE, they just cut their dividend. This is a little scary for someone who is aspiring to be a dividend growth investor, to receiving a massive amount of cash flow through dividends, and to rely on dividends for my life's income. I want to retire and live off of dividends. How can I possibly do that if big blue chip companies like GE are cutting their dividends? And Ian, in general, taking a step back, you talk about these big blue chip companies so much. But you know what, Ian? This world is changing. And some of these companies, their business models are being disrupted. They're being challenged. How can you be so certain about your strategy? I think all of these big blue chip companies are going to face troubles ahead, and that this whole strategy is going to unfold. How can you address that? So I love this question, and I am excited to address it today. And let's jump right into it. So I brought my notebook. I jotted down a bunch of notes for this one, as always. Let's just see what I wrote down here. Well, first I want to acknowledge this point. It is more difficult to be an investor right now than it was back in 2009 through 13. It's the fact of life. The stock market has gone up. It's been a bull market. There's less value out there. There's less stocks on sale. And it's more difficult to find those key entry points that minimize one's risk, maximize one's return. And so I think it's good that folks are asking this question, because you know what? A correction, a stock market correction, could be just around the corner. And there's two topics we're talking about today. One is just corrections in general, stock market corrections, downturns. Oh my goodness, what am I going to do if a downturn hits? But the other related question somewhat is dividend cuts. Because oftentimes if there is a stock market correction, it usually coincides with an economic correction or a recession, which typically is the time when if a stock will cut its dividend, a company will cut its dividend, happens around that time. So these two are related. So absolutely, it's a good time to be thinking about this type of question. I think about it a lot. It's something that's really important to think about, because this is not the climate that we were in back in 2009 through 13. Things have gone up. So here is the most important point that I try to drive home on this channel in all of my videos. It is core to my philosophy. It is what I live with day in and day out, and that is I buy and hold forever. I talk about capital appreciation sometimes because I have to make comparisons and illustrate returns. For example, I just did a video about how I am beating the S&P 500 with my stock portfolio. I'll link to that below in case anyone wants to see it. And I talked about capital appreciation there because that's the only way I can make a clear comparison. However, at the end of the day, I don't actively measure very frequently the value of my portfolio. What I do measure very frequently is how much income I have coming in through the door every month. I could not really care less if one of my stocks went down in value, as long as the fundamentals were solid. And the reason for this is I buy stocks for the dividend. And I buy stocks that can grow the dividend over time. And so if I'm buying for the dividend, I can't sell the stock. I don't want to sell the stock, because then I wouldn't have my dividend. I wouldn't have my cash flow that would allow me to live, that would pay for my expenses. So if the underlying stock fluctuates, I don't much care if it goes down. In fact, I kind of like it when it goes down. We'll get into that in a minute. But this is a fundamental issue here that, for myself at least, if a recession came and then the stock market came down, wouldn't faze me in the least. As long as the fundamentals of my companies that I own, the long-term fundamentals, continue to be solid. And the reason for that, again, is my value, my stock portfolio goes down. I don't rely on that. That doesn't really mean anything to me, because I'm not here to sell. I'm here to generate passive income through dividend checks. And those dividend checks keep coming in good times and bad. Here's an example. I shared this in one of my recent videos. I'm yielding 16.5% yield on cost on one of the stocks that I bought back in the right after the Great Recession. The specific date is in that video, the one I'm going to link to below, about dividend stocks versus S&P 500 and how I'm beating the S&P 500. So check that out if you want. 16.5%. You cannot go into anything these days and get that kind of starting yield. Certainly one can get into a stock and the yield will get there over time through dividend increases, and I'm living proof of that. And that's just what I've done with that stock and many others like it. In fact, I have many stocks in the portfolio, or multiple stocks in the portfolio, that have seen very strong success on dividend yield on cost. And so the only way I can achieve that high yield on cost is by holding forever and not worrying about the underlying stock price. So anyways, I've belabored that point a bit, but I really do want to drive it home that I'm not here to sell. So you got it. I love a down market. I love it. I can buy better value. As stocks go down, your starting yield, one starting yield, goes up. Why? What is the yield? What is this yield? It's the amount of dividends that a company pays out per year divided by the share price. So if they pay out $3 a year, share price is $100. 3 divided by 100, I get a 3% dividend yield. Let's say market just faces catastrophe. There's panic out there. And the panic is irrational, is what I've oftentimes found as well. It's so irrational. And something will happen. It will get blown out of proportion. Humans have a resiliency. We will come back. The economy will improve. The country will improve. Things will go on. But in the moment, no one will feel like that. It will feel like complete chaos. And the stock market, let's say it gets cut in half. This could happen. That same stock now, let's say it continues to pay $3 dividend. Let's say though the share price is $50. Got cut in half. 3 divided by 50, that's a 6% starting yield. What would I rather have as a dividend growth investor? Would I rather have a 3% starting yield or a 6% starting yield? I would take the 6% every time. And as long as the fundamentals, that company, are still solid, still good. And this is an important factor because if the recession hits, it's very important to pick companies that are somewhat immune to cycles. That's what I try to do every time. I'll get more into this later. But I look at a downturn as a buying opportunity. Now, I want to add here though, I'm not trying to necessarily, I'm just talking about economic downturn. There's cycles. I mean, I'm not trying to make light of bad situations out there. I mean, I very much care about people. I spend a lot of my time finding ways to donate money to charity. One of my greater purposes in life, actually, through my dividend portfolio, is, and why I even want all this passive income, is I want to contribute more to charity, not only money, but my time. And so if something really bad happened out there, I'm not trying to make light of that. What I'm really talking about today is more of a very big macro cycle. Let's just say the bull market reaches its end and the economy is heading into some of those bear years. That's what I'm talking about. And that's when there tends to be a lot of panic around that time in the media. Things get sensationalized and it will push the stock market down, and it's oftentimes a good buying opportunity for someone who has a long-term vision. They're looking well out into the future for decades on end. So what else? Let's see. I already talked about this, but it's another way of looking at the same thing. If there is a sale, Black Friday is coming up, people are going to be buying into all of these sales, all of these sales for the Christmas holiday season shopping. And when there's a sale, consumers run for it. They wait out in line. They stay up all night. They'll wait. They'll get in line for it. However, when there's a sale in the stock market, people run. They get scared. It's the only phenomenon in the entire world when there's a sale. Consumers don't actually enjoy the sale. They're not excited about the sale. They're scared of the sale. Psychologically, in my investing career that spanned more than 20 years, it's taken me some time to really get comfortable with this. This is something that if one is not comfortable with now, that's okay. It requires experience, and the experience comes with time. I'm here to say that it's important for investors to understand that when there's a sale in the stock market, prices have gone down, to get excited. This is a lesson that Warren Buffett teaches. It's time to get excited. It will allow one, put another way, to reach financial freedom, where the dividends cover all of their expenses quicker, because one's buying a sale, they're not buying something overpriced or fairly priced, they're buying it on sale. I love this one. The best companies in the world out there are going to thrive, regardless of the economy. There's a lot of innovation happening right now. This innovation benefits companies, all companies. The big blue chip companies, even if they're not tech companies, they're using technology, they're improving. They're using technology to improve their company. They're innovating. The human population continues to grow. This is especially fueled by substantial growth in India and Africa, and China as well. We've got a bigger globe. There's going to be more mouths to feed, more people to provide basic necessities of life, more people who are going to be consumers. Big blue chip global companies, they're going to benefit from this. Times are good, times are bad. One always needs to brush their teeth. These companies are going to be selling toothpaste, for example, in good times and bad. This is what's important. In my investment portfolio that has over 30 stocks, I always try to buy stocks that are somewhat immune to down cycles. In fact, some of the stocks I own do better in down cycles. One, in my opinion, wants to really focus on that point, and it'll allow them to sleep well at night despite the economic conditions, and they know they'll have a holding that will grow the dividend and weather the storm despite the cycle, despite whether it's a good cycle or down cycle. What else? Here we go. But GE just cut their dividend. There are always going to be corner cases. By the way, I don't own GE, never have, probably never will. This is a company that got hyped up by the dividend community a few years ago. I read a lot of the blogs. This is one that a lot of my fellow bloggers were buying into, or at least maybe not a lot, but at least some of them. And I got tempted, but my gut told me no. In the world of investing in dividend growth stocks, or any kind of investing for that matter, it is really important to follow one's heart, to follow one's gut, and to do very good analysis. And I'm going to be doing a very lengthy video on this shortly. Thank you for hanging in. I know you guys have been asking for this. I know it. The reason it's been delayed is it has to be good. I'm not going to do it unless it's my best work, and it's going to be worth the wait. As long as one has done their financial analysis, they feel good about something, and their gut tells them to buy, that's when one should really look at a stock, not based on the community and what others are doing. And so I avoided GE. I never liked GE, especially since the Great Recession hit, when they got pummeled. And the reason for that is, I'm trying to remember, I believe at the time they were really heavy weighted on GE credit. They were providing a lot of financing with the bank, the internal bank at GE. And they were getting into some more risky loans. A company that takes that kind of risk and makes those kind of mistakes, I'm never going to trust them again. And that's kind of how I am as an investor. If a company makes a major mistake once, I'm out. There's no second chance. None. And so I've avoided GE, never felt right about it. I feel for the folks out there that were involved in the dividend cut and are experiencing that. I had my own experience with a company called BHP Billiton, where I had to sell it, the dividend got cut. It's one of the only stocks I've had to sell because of a dividend cut in a long time, well, in my career. And mistakes happen. That being said, I own 30 stocks. If the dividend's cut on one stock, it just doesn't faze me. It doesn't keep me up at night. It's not. And the fact of the matter is with any portfolio, there's always going to be a loser. But there's also always going to be winners that way outpaced one's wildest expectations. And so way outpaced them, I'm telling you. And so the fact of the matter is dividend cuts come. When they come, they get hyped up. when they come, people start worrying, oh no, are all the dividends going to get cut? No, it's one thing, it's one company, one case. And I feel for the folks that were affected by it. I'm not trying to brag that I wasn't affected by it, because like I said, I had my own dividend cut with BHP Billiton, but one practices basic principles of diversification, it's just not the end of the world, and I wouldn't necessarily read into a dividend cut from one company as pertaining to every company out there. And certainly I wouldn't, at least the mantra that I'm living my financial journey by, I certainly wouldn't project that, oh, this disruptive technology is going to change everything, there's going to be no dividends anymore. This gets into psychology a lot, but our human brain is there to protect us. It is there to protect us from the real early days when we were out there as hunters and gatherers. And so that brain will always cast doubt in anything we do in life. And the thing that I have come to learn is, despite any apprehension, as long as one's gut tells them it's right, as long as one's analysis tells them that it's right, it's important not to let the psychology get in the way. And so that's just an important point about investing. And then once one's in a stock, it's important to have conviction and to hold forever for dividend income, in my opinion, as long as something fundamental doesn't change like it did with GE or BHP Billiton in my case. And so it's really important not to just project doubt out there, because it's going to affect one's entire life, not only investing, but everything. It's the realization that that trigger is in our mind for a reason, to protect us in those hunter and gatherer days. But now it's not those times anymore. And you know what? I'm going to go out there and achieve complete financial freedom through dividend investing, and it's going to allow me to give back even more to society than I can now. How cool is that? So just some wisdom there that I thought would be worth sharing. Okay, what else? Last point. Dividend companies in general. There are studies on this. I don't want to quote any of them. Go to the University of Google out there and search for it. How do dividend stocks tend to do in downturns? Most of the dividend stocks that I own are considered defensive stocks, meaning they do well in good economies, bad economies. They're basic necessities of life. They have been, and they always will be. And the companies are innovating to make sure that they always will be. Now, those companies that pay these dividends, because they're defensive, when the economy turns, the market starts going down, not everyone wants to pull all their money out, especially a managed mutual fund, for example. They need to place their clients' money. What do? They go into these defensive stocks, because even though the market's down, at least you still get these dividends coming in, and it helps prop up the defensive stocks during difficult times. And so I always like to think, especially backed with data and studies, that during the next recession, during the next downturn, and maybe it's going to be different than in the past, but in general, types of companies that I own, they've weathered pretty well in those times. So this is Ian Lopuck. I'm from ppcian.com. If you enjoyed the video today, please, I invite you to like, to comment, to subscribe. That's the best way that you can support my channel. Also, before I leave today, just a friendly disclaimer, I'm not a licensed financial advisor. Today's video, it is not financial advice. Today's video is just for your fun and entertainment. If you are going to go out and invest money in the stock market or anywhere else, please do consult a licensed financial advisor first. I thank you so much for watching. I will see you in the next PPC Ian Dividend Investing video.